Okay, welcome to A Better Lifestyle, everybody. Today I have the pleasure to have Simon Popple with me. Welcome, Simon, to the podcast.
Great to be here. Thank you very much.
It's my pleasure. So, Simon, tell us who is Simon Popple and what do you do exactly?
Sure. Well, by training, I've got very traditional training of MBA, investment banking, property. Made my money in property, funnily enough. But then about sort of 15 years ago, I decided that commodities, in particular gold, were the future. I probably left the property market a good 10 years too early, but I'm pleased I left it. And what I find is there's lots of resources out there saying why gold is a good investment, but no one really tells you how to invest in it, and that's basically what I do. I teach people how to invest in gold and how to put gold portfolios together.
Okay, so there's different ways to invest in gold. So, talk to us about the different ways people can invest in gold.
Sure. Oh, well, look, um, there's lots of different ways, as you rightly say. I mean, you've got physical gold, you've got funds such as ETFs and mutual funds. You've then got very large companies, you know, 50, 60 billion market value. You've then got smaller but large companies. I call the large companies a goalkeeper. You've got very large companies which are sort of probably market value of around 10 to 30 billion. And then you've got smaller producers. These are all producers that are kind of typically in the kind of 5 to 10 billion market value. And then you've got the explorers, which are, they kind of tend to be less than a billion. Some are slightly over a billion, but that's broadly what the market is. And what I do is I teach people how to have a balance of all those components. One of the problems you have with the market is a lot of people they just buy one or two, so they may get some gold or they may get an explorer, but that's not the way you should allocate capital. You should allocate it across a broad range of products to help you on your gold journey.
You talk about the physical gold, and I think there's you could buy ETFs and stuff like that. You talk about the Explorer, and I think another one. Can you elaborate on what are those exactly and how they work?
Yeah, sure. Look, you've got the physical, you've got funds, which tend to be a mixture. The funds vary enormously in terms of what they invest in. Some have producers, some have explorers, some have derivatives, some invest in physical gold, some have a combination of all of those. Um, and then you've got, uh, in my terminology, I have goalkeepers, defenders, midfielders. These are all producers. These are all producing gold. But because the gold is in the ground, you've got what's known as operational risk, because uh, you know the ore is there, but you've got the risk of actually mining it and processing it. Uh, with an explorer, again, lots of different types of explorers. You can have an explorer that is perhaps already found gold, but just not in production, and obviously hoping to find more. Or you might have an explorer that's got no gold. You could have a combination of all of them. And again, that's what I teach people. Don't just go for the highest risk explorer. You want to have a portfolio that's suitable for you.
What are the average returns on these things?
The average returns, it varies enormously. I mean, um, it's like any investment. There's huge amounts of risk for explorers. You could uh, with an explorer, you can get sort of 10, 20, 30, 50 times your money. But what you do need to be aware of is that there's real risk involved here, and you're not um, uh, you know you, you have to take that risk. Um, and should you have an explorer, then I think yes, that makes perfect sense. But you should have a midfielder. You should have a defenders. You should have uh, physical gold in a fund. And in terms of what return you can look for, you could say that the average return on gold since 2000 is I think it's over 10.6%. So that's the average return on physical gold. Um, Now that is, you'd hope for a return over that, but there's no guarantees. Prices of gold go up and down, prices of shares go up and down. But what I say to people is, with my product, you can have your money back if you if you don't get a return of 10.6%. So I think there's a kind of uh, you can hope for a return, but there's no guaranteed return. I think that's one of the problems that people have. They want a guaranteed return, and you can look at what gold has returned in the past, but that doesn't guarantee you what it's going to return in the future. And so um, this is this is for people who uh, want to uh, are okay with some volatility because the price of gold moves up and down. But by having a diverse portfolio, you're not totally exposed to the gold price. You're exposed to lots of different investments, and what you're hoping for is that the volatility across the portfolio is significantly lower than the individual parts. I use a fantasy football analogy, so I'm looking for the team's performance rather than the individual player's performance, if you understand what I mean.
You mentioned the price of gold going up and down. What makes the price of gold go up or down?
Right. I mean, there's no one thing that makes the price move. I think I look at four drivers, which I refer to as MIDI. MIDI is an acronym for market uncertainty, interest rates, debt, and inflation. The more market uncertainty you've got, the better it is for the gold price. If inflation is going up, the better it is for the gold price. If debt is going up, the better it is for the gold price. If interest rates are coming down, the better it is for the gold price. But there's a caveat there, and that is like the Iran war is a great example. We have the Iran war. Um, Now the gold price went down, so you've got greater market uncertainty, but gold price is going down. But all those factors interact, and one of the reasons why the gold price went down is it was viewed that interest rates weren't going to get cut anytime soon. Um, and the other factor is that when there's a war, um, countries need cash, and when they need cash, they sell what they can rather than what they want. And if they sell gold, the price obviously goes down. Um, so do those things drive the gold price? Absolutely, but you get some short-term volatility. So I would say that gold is not a suitable investment for investing for less than a year. And I think the other point I'd make is you can't control the markets, but you can control how you invest in them. And so I wouldn't say to someone, "Oh, now is a good time to invest in gold. That's a bad time," or whatever. I'd say, spread your investments over a period of time. Let's say a few months, and typically one of several things will happen. Either the price will go up, in which case you've made some money, and you may think, well, actually, I don't want to put any more money in gold. I'm happy with what I've got. Or the price will go down, in which case you invest and you're buying cheaper gold, or the price will stay the same. And you can then decide, do I want to put more in? Do I not want to put more in? But I think that the key thing is that you control what you do, and um, you're also talking about a very liquid asset here. You're not talking about property or private equity or something like that. You're talking about something where if you want cash, you can get it very quickly. And not only can you buy physical gold through a dealer in a liquid form where you can get your cash back, but you can also buy listed funds and listed shares. So obviously you've got a time to transact and time to settle, but quite often you can get the money back in a week, certainly 2 weeks, if you need the cash. So I see it as a very good short term, well, let's say short, medium to long term place for cash. And depending on how important the cash is to you and when you're going to need it, I would look at having, if you may need it in a few years, and then perhaps having more of your cash in physical gold. If you don't need it for 10 years, whatever, then you may have more in midfielders and forwards. But it's it's all about balance, and it's all about deciding what is right for you, and what's right for you may not be right for someone else.
So someone who has physical gold, if they want liquidity, it will take probably 2 weeks.
Yeah, a lot depends on how they hold the gold. I mean, if they bought it through a bullion dealer and they stored and insured it with a bullion dealer, quite a lot of dealers have got a facility where you can sell it. You can normally sell it within 24 hours. They'll give you the spot price. Plus, you'll probably pay a premium because that's how they make their money. You pay a slight premium when you buy, a slight premium when you sell. That's how a dealer makes money. Um, but you could also buy it in a tax efficient way. For example, in the UK, you can buy gold through your pension, so you don't pay capital gains, or you can buy coins where you don't pay capital gains. So buying gold can also be very tax efficient, and I think it's important that people look at not only the return on gold, but the kind of the net return on gold when they compare it to other assets. Because if you're getting taxed at 40% on something, um, then the money you walk away with may be very different to if you're being, you know, not taxed at all on it. So um, I think that's very relevant for investors.
So you mentioned about the tax. Since there's different ways of investing, is the tax system or the tax issue is the same for the different types of when you invest? Let's say you buy physical or the other stuff.
No, I mean it's tax is a very personal thing. It depends on where you're domiciled, obviously, and you need proper tax advice. But for example, if you get bullion of a certain purity of bullion is allowed in certain pensions. Um, in the UK, you can get coins, which are capital gains tax free. You can also invest in an ISA, which is a sort of a tax wrapper in explorers or defenders or goalkeepers or midfielders, whatever you want. The reason I mention explorers is if they take off and let's say they go up 10, 20 times, you don't want to have a tax headache, and it's quite nice if you've managed to invest in something and got a tax-free return. So that can be very attractive for people.
So what's the startup cost if someone wants to buy physical gold?
Well, I mean, this is a real sort of misunderstanding with gold because people think it's a rich person's game. You could invest in gold for as little as a couple of $100, probably 150, £175. Um, if you're going to build a portfolio, obviously you want each investment there's a cost to each investment, and you don't want the investments to be so small that the cost outweighs the potential return from the investment, if you see what I mean. So I would say you probably need £800, so $900 to $1,000 in each investment. And if you're just starting out, I would say to people perhaps buy physical gold and funds, the kind of lower risk opportunities. I help people more at the sort of $10,000 plus side of life because if you get the gold system, you get a list of mining companies and funds, and so you only want to have the list if you're looking to invest in companies and funds. So I would say if you've got, let's say, less than, I don't know, $3,000 to invest, I'd probably just go into physical gold, perhaps get a fund. If you've got more than that and you hope to have more than, let's say, 10,000 within a year, that's when the likes of the gold program system can help you. But it's not really suitable for people who are only looking to invest, a few hundred dollars or perhaps $1,000 or something.
Would you say gold is driven by supply and demand?
Yes, I mean, look, you can't print gold. It came to Earth from meteorites thousands, if not million years ago. If we get hit by another meteorite, we won't be around to tell the story. And there is a limited supply of gold. It's in the ground, and I think technology is helping discoverers, but there's been no major discoveries in the last few years. But with drones and AI and things like that, it's possible to do a lot more analysis more cost effectively than it perhaps used to be. But yes, I think there is an element of supply and demand. And I think the other thing I'd say is that gold is a global asset. I can't think of any other asset you can take anywhere in the world and people say that's valuable. Gold is clearly one of those assets. And I think that's particularly useful because if for some reason you want to move to another country or you need value in another country, actually having some gold could be fantastically useful.
Can you borrow against that asset?
No, because gold doesn't yield anything, and so um, if you want to borrow, you need something that yields something, and that what you tend to find is companies will borrow because companies are producing cash. So what if you want leverage, what you could do is you could buy gold mining equities because they will borrow, um, and so you've got leverage within that investment. Uh, they also often pay a dividend yield, which is probably not more than sort of 2.5 to 3.5%. So it's probably not enough for you to borrow against that particular asset. But what you probably could do if you wanted to is you could perhaps have a portfolio and borrow against part of it um, to to sort of increase the size of your investment. But I think that's quite a risky thing to do.
We were talking before about the interest rates and all that. How does gold perform in a recession?
Uh, it's a very good question. I mean, a lot depends on what causes a recession. Um, I mean, gold, talking about those four things, market uncertainty, you've got buckets of in a recession. Interest rates, typically, when interest rates go up, that's bad for gold because you've got as I just mentioned, gold doesn't yield anything. So you've got an opportunity cost of, let's say, interest rates of 5%. If you're going for going 5%, you may think, well, I'd rather have that 5% than have gold. Whereas if interest rates are only, let's say, 2%, you're losing less yield by having gold. So higher interest rates are bad for gold. But debt is so high at the moment. I think people are nervous, and therefore that is good for gold. And inflation. Uh, if you're holding cash, let's say you've got, I know, $100, £100, whatever it is, and that can buy your 10 favorite bottles of wine. And then I lend you money at, let's say, 10%. So in a year's time, you've got $110 and pounds, whatever, and you pay me back £110. But I can only buy 9 bottles of my favorite wine because of inflation. Then even if interest rates are 5, 6, 7%, whatever they are, if inflation is running away, you're going to say, well, actually, I'm going to not charge you 10% next year. I'm going to charge you 20%. And I wouldn't mind getting that bottle of wine back either. So rather than 20%, I'll charge you 30%. So I think that, it's a slow moving asset. But if inflation really takes off, um, and interest rates, you can't really raise interest rates to counteract inflation like you used to be able to because the debt's so high and the cost of servicing the debt would lead to a default. Then you've got a real problem. And I think that's why gold could do incredibly well.
Now we have this big debate with gold and Bitcoin. So what's your thoughts on that?
So gold and Bitcoin. Well, Bitcoin, I, if you notice, Bitcoin is actually depicted as a gold coin, which makes me smile a bit. Um, Bitcoin, it's a digital asset. It's created by computers, and whilst I think that there's clearly a use for having something that is global and that you can trade all over the world. One of the the big sort of fanfares when it first came out was the fact that it was untraceable and it was agnostic and things like that. And Bitcoin is actually one of the most traceable assets you could ever wish to get. If the authorities want to know, what transactions have happened, even though there's code, they can get details of the code, so they know what's happened. So, gold versus crypto, I'd go for gold any day of the week. But crypto is it's certainly an interesting thing to have in your portfolio, but I don't understand it. And if crypto was, let's say, I don't know, $10,000 or something, then I could see perhaps you may want to have one in your portfolio. But buying one for whatever the market rate is at the moment, something you don't understand, and it's a digital asset, I'd be concerned about that. And I think just to add to that, countries, at the end of the day, their currency is very important to them. And if there was ever a decision to make between having a currency and having crypto, I think a country would go for a currency any day of the week. So I don't think crypto is. I don't think it's a bad asset at all. But I don't. I don't. If I was given the choice, gold or crypto, I'd always go gold.
So you don't think Bitcoin is going to replace gold as an edge for inflation, or just an edge?
No, not at all. Not at all. I mean, I think that you've got to be very careful about talking about gold and inflation because inflation only goes up, and the gold price goes up and down. So it may be a hedge for inflation in some instances, but some instances not. So do I see crypto as a hedge against inflation? No, I don't. Do I see it as being part of a broader portfolio? Yeah. I mean, the performance has been very good. And even though I don't understand it, I don't have any at the moment. But if I decided to get some in the future, I don't think I'd buy much. But I believe in diversity in terms of portfolio, not just in terms of gold and gold companies, but there's no harm in having some bonds, equities, and crypto as well as gold. But I think these people who say, "Oh, it's going to replace gold," I wouldn't say that at all.
So in a portfolio, where would gold be in diversification, like the percentage of gold in your portfolio?
Yeah, look, I get asked this a lot. I mean, I think a lot depends on sort of how large the portfolio is. But I would say you probably want, let's say, 20% in alternatives. Now, alternatives, I would include crypto and gold and commodities, and private equity and things like that in those alternatives. Now, going back to my point earlier, you don't want to have so little of any of those that the costs outweigh the benefits of having them. So a lot depends on how much money you've got, and where you are in life, and what you want from your portfolio. Your portfolio will be very different if you're 70 years old than if you're 17 years old. So, but yeah, I think alternatives should be a meaningful part of any portfolio. And I'd say personally, I'd say at least 20%, probably more. But and gold would be part of those alternatives. But depending on how much money you've got, then that would depend on what you've got in the alternatives. Um, and I think I'd also say liquidity is also relevant for alternatives. If you need liquidity, then I don't think private equity is a particularly good thing to have. Um, but if you don't need liquidity, then private equity could be a great thing to have. So, there's lots of different questions to ask when you put your portfolio together.
I believe before you were talking about long-term play or short-term play. Is gold a long-term play?
Gold is very much a uh, it's a long, when I say long term, it's like at least a year. Um, and I'd say probably more like 18 months plus. You don't want to have uh, because the price can be volatile. You don't want to be in a situation. I'd say this with any investment, to be honest, not just gold, but any investment. But a mistake that a lot of people make is they make a perfectly rational investment, but they need the money within 12 months or 18 months, whatever it is, and end up selling that perfectly good investment at completely the wrong time because they need the money. They sell what they have to sell rather than what they want to sell. And for that reason, I don't think you should look at gold as a short term investment, but perhaps over a year. And again, it depends what you're buying. If you're buying an Explorer, then I'd view that as a much longer term investment. If you're buying physical gold, then a year, hopefully you'll be fine. But going back to that average of over 10.6% a year since 2000, now that's an average percentage. So you could buy it in a year that's particularly bad, but you could buy in a year that's particularly good. Uh, there's no guarantees. And I think that's the key, not just with gold, but with any investment. There's risk attached. And these people who say, oh, well, actually, I've got something without risk because I'm guaranteed a 5% return. You might be guaranteed a 5% return, but you're not guaranteed what inflation is going to be. And it might be that if inflation's running at 10%, and you're guaranteed a 5% return, then you're losing, you're guaranteed to lose 5%. If you're with me,
So what do you see gold in the future?
I think the direction of travel is very clear. The direction of travel is the gold price is going up. The speed at which it goes up is far more difficult to determine because things like the Iran war and uh, supply and demand, as you mentioned earlier. There's a lot of things that can impact the price, but I think the gold price is going to go higher, and I think that people need to uh, have some in their portfolio, and they need to understand how to invest in it. And it's not just a matter of going out and buying gold. There's lots of other ways to invest in it.
Where can people learn more about you and follow you?
If they go to www.goldprogram.co.uk, I talk about gold itself. I compare it to property, for example, and I talk about this 10.6% return. And obviously, you can get the Beginner's Guide to Investing in Gold, which is a book which is less than the cost of lunch is £9.99. So you can learn how to invest in gold. If you want to go a bit further, then you could get the gold program system, which is about £149. And then I've got a course, and if you want to have a chat with me, then that's obviously more money. But if you're just starting out, then if you don't have the money to invest in gold, then I'd suggest you just buy the book. And if you've got several £1,000s, dollars, and you're looking to actually invest in gold itself, then get the gold program system and come on board and see if I can help you.